Have you ever wondered how all the money in an economy actually fits together? Where does it come from and where does it go? It can feel like a huge, complicated puzzle. But what if I told you there's a framework that makes it all click into place, like a perfectly balanced set of scales? That's what stock flow consistent models are all about. And today, we're going to break them down in a way that's simple and practical. So, let's start with the basics. Imagine your personal finances. You have a certain amount of money in your bank account right now. That's a stock. It's a snapshot at a single point in time. Now, throughout the month, you get a paycheck and you spend money on groceries, rent, and maybe a movie. These are flows. They are measurements over a period of time. Your income is a flow into your account, and your spending is a flow out. The crucial part is that these flows change your stock. Your final bank balance at the end of the month is your starting balance, plus your income, minus your spending. Simple, right? Stock flow consistent models, or SFC models for short, apply this exact same logic to the entire economy. Instead of just you, they look at all the major players, households like yours, businesses, the government, and even the rest of the world. Every single financial transaction is tracked. For every dollar that flows out of one sector's account, it must flow into another sector's account. There are no magic money leaks or mysterious injections. Every asset has a corresponding liability. It's like a giant, interconnected accounting system for the whole country. Why is this so powerful? Because it forces us to be honest about how the economy works. Let's think about a common headline. Government deficit spending is out of control. An SFC model helps us see the other side of that coin. When the government spends more than it collects in taxes, it runs a deficit. That deficit spending has to go somewhere. Where? It flows into the bank accounts of the private sector. That's households and businesses. So, from this perspective, a government deficit is, by accounting identity, a private sector surplus. It's not a good or bad thing on its own. It's just how the flows balance out the stocks. The government's debt is the private sector's financial asset. This framework allows economists to build realistic models of the economy. They can ask questions like, what happens if the government increases spending on infrastructure? The model can trace how that money flows from the government to construction companies, then to their employees as wages, and then how those employees spend or save that money. It tracks how these flows change the stocks of debt and savings across all sectors. It helps us see the ripple effects throughout the entire system, preventing us from looking at one piece of the puzzle in isolation. It ensures that our story about the economy is complete and consistent. So, the next time you hear about economic policies or financial news, try to think like an SFC modeler. Ask yourself, where is the money coming from and where is it going? Who is gaining a financial asset and who is taking on a liability? By understanding that every flow affects a stock and that the whole system must balance, you'll have a much clearer and more powerful lens for understanding the complex world of macroeconomics. It's not about abstract theories. It's about simple accounting, applied on a grand scale. Thanks so much for watching. If this helped you see the economy in a new light, be sure to hit that like button and subscribe for more videos that make complex topics simple. See you next time.